This podcast is intended and contains general information on financial strategies, investments, and products only. Whilst Luke and I are both licensed financial advisors, we don't know your personal circumstances, goals, or objectives. We highly recommend that you reach out to your financial advisor or investment professional to discuss any of the topics that we've covered today before taking any action. Our full disclosure, copies of our financial services guide, and additional information about Seneca Financial Solutions and Bold Wealth can be found in the show notes. G'day, and welcome to another episode of Wealth and Toil. My name is Dylan Pargiter-Green from Bold Wealth, and I'm here with a couple of absolute larrikins from Seneca Financial Solutions, Luke Laretive and the one and only Ben Richards. How are you, lads?
G'day, Dill.
Excellent, thank you, mate.
It is good to see your face, Ben. You always make this podcast so much more fun.
I think he's the most popular I think Ben's last episode is our most popular, most downloaded episode. So, you know, my mum and Ben's mum sort of doubled the audience. So
Must be my family, yeah.
Yeah, Ben's exactly right.
You got lots of brothers and sisters, Ben.
Yeah. Send it out to the extended family group chat, pump the numbers.
Yeah, exactly right. We need to pump the stats.
Granny's on Apple Podcasts just trying to figure out how to like and subscribe.
Go on, Grandma. Go on.
Nah, it's good. It's good. How's your week been?
Yeah, pretty good, mate. Been a little bit busy. Went up to Sydney on Wednesday and did my first ever buy, hold, sell with the guys at Livewire, which was a bit nerve-wracking, a bit exciting to be doing something new because, you know, we don't do enough media and content as it is. So I might as well get on one more platform. So, really stoked to do that and went pretty well. Did it with Steve Johnson from Forager, who, you know, decent investor and kind of thinks about stuff at least sort of similar to us, which makes it a lot easier. And
no fights?
No fights, and yeah, good overall. Good overall experience, and yeah, very grateful to do it. I think Ben's going to go up and do the call for Ausbiz next week before he jettisons off to the European sunshine for the four. Who gave him 4 weeks off? That's what I want to know.
I don't know. Yeah.
That's what accumulating leave.
That's what happens when you make your employees work on Christmas Day, mate. It's
no, market's open. You're on the desk.
Yeah, you're going to go and spend 4 weeks. And Ibiza, I think, just selling bottles of water.
I'm not going to Ibiza. I'm not allowed.
Not you.
Oh no.
No, not quite that outlandish. Should keep it nice and quiet. The quieter Greek islands, if that's such a thing that exists.
Oh dear.
Very good. Very good. Anyway,
we'll push on with the topic of the day, probably, Dill, rather than Ben's current trip to Europe.
It's a separate podcast.
That's going to be it's more of an Esther Perel type sort of setup, I think, by the time he comes back.
Righto. Well, look, it is end of financial year, and whilst some of us who have some time sensitive work have had our head in the sand with all things superannuation strategies, I thought it would be a good episode this week to do maybe a highlight of some of the big things, big trends of the year or the financial year, which is why we've got Benny on, because he is the one who actually knows what's going on with all of this. And Luke writes content, and I do something else. So, Luke, where do you want to start? Like, what's the probably big question that you want to start with?
Well, I think, like, you know, people always ask, you know, what's been the tale of the first half, and, you know, from a market's perspective, and I think, you know, taking it from the highest possible level from an asset allocation kind of perspective is we've seen, you know, US equities and large cap US equities just kick ass. They've just been, you know, outperforming everything. I think the MSCI World Index is up like 17% in the first half, which is amazing. And certainly we haven't seen that sort of growth here in Australia, even after accounting for dividend reinvestment. The story locally here has been one of, you know, it's always a story of sort of industrials versus resources, or resources versus kind of everything else. Industrials is kind of the catch-all name for kind of everything that's not a miner on the ASX. And certainly the everything else has outperformed the resources sector dramatically, about 14-15%. So it's been a case of you want to be out of BHP, out of Rio, out of Fortescue, and in Commonwealth Bank and the banks and the other industrial companies. Now, whether that's going to work in the second half, I would probably argue no, but that's certainly been a strategy that would be winning in the first half. And it's something that has been driving the returns. I suppose is really been this rotation out of resources and into other stuff.
And resources had a pretty good 2023,
2022, 2021. They've been pretty good for 3 or 4 years now, and it's not all parts of the resources complex. Gold and precious metals and base metals had a pretty good first half, but I suppose our index is different to, say, a lot of other geographic regions around the world, in the sense it's what's normally called like this barbell. It's banks 25% of the index, iron ore miners another sort of 16 or 17% of the index, and everything else really sort of pales in. REITs probably another 6 or 7%, and then everything else kind of falls in after that. So if you talk about what's going to drive returns in Australia, it's always going to be the iron ore price, it's always going to be the outlook for banks, and it's always going to be to a lesser extent the outlook for property. So it's a bit of a. That's why I don't believe in index investing in Australia. It's not necessarily because you can't generate decent returns. It's more so because the composition of the index is pretty undiversified and doesn't actually give you a broad representation of the Australian economy. What it does, it gives you exposure, as I said, to iron ore and to banks and to REITs, which historically have all been pretty low return parts of the economy from an investment perspective.
Yeah. All right. Well, let's jump into some of those trends and talking to maybe even some specific stocks or what has been the big driver of our market here over the last 6 months.
Yeah, I mean, it comes back to banks and resources, really. Like banks, particularly Commonwealth Bank, has been remarkable. I can't remember the exact price, might be 125. Despite earnings have pretty much gone sideways, and I know that's something we focused on in the Livewire episode that dropped this morning in terms of the outlook from here. If you're buying what is objectively the most expensive bank in the world on over 20 times PE, then it's going to take years to grow into that valuation to come back to a market valuation. And
well, I mean, you would argue maybe it never grows into that valuation. I mean, there's not really been material earnings growth in the banks over the last 10 years. I think we talked about it on Rask as well, and I think CBA's had cumulative earnings growth, not annual, cumulative earnings growth of 4% over the last 10 years. So you would never grow into a PE of 22 times, which is what it's trading on. It's almost 23 times now trading on at the moment, and certainly. From our perspective, we don't see CBA as that different to NAB, Westpac, or ANZ to justify the gap, the premium gap at the moment. Certainly, I think it is a more, it's got a better track record, I should say, than the other three banks of being able to sustain earnings in weak environments. But I'm not sure that's going to be, the case in the future. And certainly, at the moment, it looks like it's the only bank. If the valuation's anything to go by, that is going to sustain in a weak consumer environment. But I was going to say, Benny, on the back of sort of that, our thoughts around CBA, what's happening to the consumer? What's happening to even today? We were talking about this morning. What can you give us a quick rundown on the real economy? What's going on out there with people's spending? Because I think this is much more relevant to the argument of, or the conversation around, what we're going to do in the second half. And I think it's been a long time coming.
Yeah, so a couple of retailers with profit downgrades today, being Kathmandu in the the clothing segment, puffer jackets, which is probably we should be coming into a good time of sales for them cyclically in the
it's cold as
time, but
the Tassie tuxedo, that's what we call it.
That's it. And Mosaic Brands was the other one. So both of them.
What do Mosaic Brands do, Benny, for the people who don't know?
For Dylan.
I think it's one of those conglomerates which owns a few different brands. So what are some of their brands? Miller's, Rockman's,
Noni B,
yeah, Rivers. So it's kind of general clothing exposure.
Exposure.
Yeah, and we just look at some of these retail names versus the bigger ones, being Westfarmers and to a slightly lesser extent Premier Investments. And they've actually held up quite well, particularly Westfarmers. We're just looking at West's earnings. I mean, the share price has, outperformed over the last 12 months despite this kind of weakening backdrop, and some of the smaller players, like we've just mentioned, struggling a bit more. And yeah, I think it's
I just don't think they're immune. My gut feel for this is that you can be the best retailer in the country. You're just not immune to a slowdown in consumer spending. And I think it's starting to come through, whether it's like the lower end spending, like your Rivers and your Noni Bs and your sort of budget end, whether it's your sort of mid-tier end, like a Kathmandu, or whether you sort of go up the price points to, or the more discretionary spend like a Smiggle or a Bunnings or a trying to think of another who owns Platypus? What's the one that Platypus shoes? That company of Accent Group. Yeah, like there's a bunch of other listed sort of consumer discretionary names, and Harvey Norman, JB Hi-Fi, obviously, but I just can't see apparel, electronics continuing to do well. And I mean, we've been saying this for a while, and we've missed opportunities to outperform in the likes of JB's, Harvey Norman, Super Cheap Auto, because we probably sold them a little bit too early, and the earnings were a little bit more resilient for a little bit longer than we expected. But certainly now, I think that the red flags are now they're on fire. You know what I mean? Like it's
I think this like you said has been something that's been coming for a long time. It's the writing has been on the wall. Interest rates haven't moved now for more than 6 months. We've had multiple inclinations that people are going to stop spending money.
But they didn't. The thing is, they didn't, and I felt like it was
people are going to stop spending money
eventually.
Some point. Eventually, right? And I don't know. This is why we've talked about this before. I have issues with inflation data. I have issues with the way in which that our country, despite being relatively, technologically advanced and data driven in some of these decisions, seem to be making decisions from months and months ago, despite knowing that some of these things are going to have a long timeline of, I guess, implementation or effect on actual behaviour. So I think that people only change when they start to feel pain, and people generally in a spending and a behavioural sense don't actually make the changes until there's a sting or a moment of actual, like a slap in the face. And that's why I think that people haven't done this yet. It's probably why things like JB Hi-Fi and Harvey Norman continue to have some of those higher earnings. But I also think that at some point, people are going to get this dopamine hit of interest rate drops, whether that be, end of this year, start of next year, middle of next year, whenever it is. And they're going to go, ooh, I've got an extra $100 in the bank. So there's potentially a future opportunity for some of these companies that you're saying, and I agree, will probably drop over the next six to 12 months. But finding that moment where these consumer items are going to become, a part of people's life that is able to be participated in again is going to be a good opportunity.
But that's where this, I take it back to the banks, and they're really pricing in an environment where credit expands. We have, more mortgage debt. We have more consumer debt, more business debt. They have higher earnings. They have less margin pressure, less competition. In fact, let's just pretend the valuations aren't extreme, even if they were just fractionally elevated, which they're not, let's be clear. But that would be the sort of environment that the banks are pricing in. So I kind of feel like we're starting to see the fractures in the consumer, but particularly in large cap, particularly the top end of the market, Westfarmers, CBA, these sort of businesses are pricing in Goldilocks consumer conditions. So Goldilocks plus consumer conditions, in our view. So I just think that these sort of news points, sure, does it matter if Noni B has a downgrade? No one owns the stock anyway. Like, who cares? But it does kind of tell you a story about what's potentially happening in the economy. And that matters for Smiggle, that matters for Bunnings, that matters for Commonwealth Bank, that matters for everybody, right? So I think, from my perspective, these are red flags, and it's going to be really interesting how it goes out, how it goes over the next 6 to 12 months, even if there is a rate cut deal. And I think if there's a rate cut, it's only going to be worse, because the reality is it's the RBA reacting to a real reduction in consumer spending, a real decline in wages, and that can be quite a problematic mix when you've got disinflation coupled with slow or no wage growth, and can be tricky. So I'll throw back to Benny, because there's one other sort of retail consumer stock that I want to touch on today, and that's yesterday's IPO of Guzman and Gomez, the burrito shop. Now, I like everybody, am partial to a GYG burrito from time to time. However, Benny, talk to us about why this stock is up 30% on IPO, and if we should be buying this thing at $30 a share.
Tacos rule.
Something like that deal. I was $28.50 today. It's down a frac, down 5%.
Down a frac. Very interesting one, this. And I could probably talk about it for a few minutes, but...
Well, talk about it for a few minutes. You've got the air. Let's give him the breach.
Come on.
Yeah,
give him the microphone. Give him the stand.
They've essentially... they've just listed yesterday at midday. They've got a bunch of, fast food, Mexican... I mean, I'm sure everyone's pretty familiar with the stores and the brand name. In Australia, I think they've got just over 100 stores. And it's been one of those rapid growth stories. And I think the key is investors have done well in similar stories where there's a clear rollout thesis. Like you think about Lovisa, you think about even like early days, Bunnings, things like that become category killers. And even fast food chains, McDonald's, KFC, in the US, Chipotle has done quite well. So it's a pretty easy to understand business model. And
what's the bit that's not easy to understand, Benny? What's the bit that's not easy to understand?
Well, the financials are really concerning, to say the least.
Oh, dear.
So let me just point out a few red flags. One is that
doesn't
it's
the
not
red flag mean that it's spicy?
This is certainly grabbing headlines, so spicy is the right way. But so the first thing is it doesn't make that much money. It's not that profitable. They've priced the IPO on 32 times normalized EBITDA. So
normalized has got should have a big spicy chili, 5 chilies next to the top right hand corner.
5 chilies. You know what Charlie Munger says about EBITDA?
Yeah, exactly right. Well, we like EBITDA, but we don't like normalised EBITDA when the normalisations are a bit fugazi, shall we say.
And if you're paying an EBITDA multiple, even for a high growth story, it's generally going to be, maybe 15, 20 times at the top of the range for a lot of these kind of businesses. I mean, Collins Foods trades on 15 times PE or whatever it is today.
So I think it's something like 7 or 8 times, or maybe 7 or 8 times EBITDA. It's not expensive.
Yeah. So anyway, that's the first point, is that it's expensive, and that's before looking at things like lease accounting, which has raised some question marks in the Australian Financial Review. So if you kind of add back lease expenses, then it's barely makes any money at all.
Which you think if you're running a retail premise, like let's talk about lemonade stand that we start tomorrow, you would think that the cost of the tenancy would be relevant to our profit.
100%, and it comes back to this.
Just saying, just saying, not a
comes back to the AASB accounting treatment. So a lot of these retailers are kind of hiding behind the new standards, really.
And this is what I mean when people ask me about accounting standards and it's too detailed. Just tell me about the story. Tell me about the narrative. Tell me about the company. It's like, well, yeah, if you just told a story about Guzman and Gomez, it all does sound pretty good and you probably would pay almost any price for it. But the reality is when you get stuck into the details, it is not as clear, and sometimes the story is obfuscating the truth.
Yeah, I mean, I can sit around a fire and tell a bloody yarn, but I can't list that at IPO at 32 times, can I?
And
well, you can. Yeah, apparently you can. Apparently you can.
Apparently you can.
It comes back to how they've constructed the float, I think. So this is... I actually read today that it was the best performing private equity float since Nuix NXL, which is
that's a whack from the journal. That's a whack from the journalist. That's a whack.
Yeah. But I think they've constructed it really cleverly in the sense that all the pre-IPO shareholders, TDM Growth Partners was a big backer, and there's a whole other range of fund managers that took stakes pre-IPO, have not only not sold down but have supported the float in their public markets, public equities funds, as well as a myriad of brokers to support the raise. And now you look at the size of the raise compared to the size of the company. They were initially targeting circa $200 million raise. I think they upsized that with good demand to 300 versus the market cap is probably, $3 billion.
Yeah, I think so.
It was initially 2 and a bit billion, and it's opened up substantially.
Yeah, so it's over 3 billion now. Yeah.
Yeah, so really tight free float. And, in these IPO situations where it's, initial pricing is more a function of supply and demand rather than fundamentals which kind of come in over the longer term, you can really get some sharp moves higher if there's good demand. So,
but we do this ourselves. Like we look at this sort of stuff all the time. So Ben and I, when we're looking at smaller companies, and it's the same thing that happened with Sun Silver, SS1. It was the same thing that happened with James Bay. It's the same thing that's happened with lots of companies over the years, and that is that if you've got demand from investors, but you're only the company might be valued at $1 billion or $3 billion in this case, but you're only 10% of the stocks available, and the other 90% is tied up. Well, there's just more demand than supply, and the shares that do trade will trade at a premium to their fair valuation. So. I'm not saying that this is crooked or no one should do it. If you're listing a company, you are entitled, as long as you meet the ASX's requirements from listing rules, etc., you're entitled to free float as much stock as you choose. There's no rules against this. All I would caution people against is that when you do have a tight free float for a short period of time, the share price can become inflated because you have more demand than supply. And eventually these things work themselves out, but it can take some time. I think GYG here are saying, well, we're going to have more news flow. We've got more rollout. We're still growing. Essentially, this is just to create some liquidity for some very long-term shareholders. But I suspect that they're going to be back to market soon. That would be my gut feel for this is that they haven't raised enough to do what they want to do, and you're going to have another cap raise for this within 18 months. How
many burrito stores do we need?
Well, this is the big question, Dill.
This is us. This is us.
They've got 171. I just looked up the numbers. 171 last year. Projected 195 stores at the close of this financial year. And they've highlighted a 1,000 restaurant network opportunity. Now, where? The US. Now, is selling Mexican food in the US going to be a viable new entry strategy?
High return on equity strategy? I don't think so.
I think by comparison to an Australian market, and this is very anecdotal based on my travelling around the US and also Mexico, I don't think that US has a lack of quality Mexican food. Like there is a lot more competition in the US for Mexican fast food than there is in Australia, where they filled a really niche hole.
I wouldn't even say it's a niche.
I don't know a lot about this, but it's just wow.
Yeah.
To me,
not necessarily
I'm not saying that there is not a rollout story here. I'm not saying it's not a good product. I'm not saying they haven't created some brand loyalty. I'm not saying they're maybe even the preferred supplier of fast casual Mexican in Australia. I would definitely argue against them saying they're going to be able to achieve a similar position in the US, and I would certainly have question marks around paying 30 plus times earnings for that opportunity when I can buy something like, I don't know, Collins Foods on half less the valuation, who have rolled out a similar story and kind of already done it and already kind of continuing to grow. So I just can't see what the appeal is here. I can only put the 40% or jump in the share. Was it 40% yesterday, Ben? It was up?
Yeah.
Yeah, 40% jump in the share price on IPO down to the balance of buyers and sellers. And I know that's a dumb stockbroker thing to say, but it actually is when you've only got 10% free float. And I think that this will work itself out in due course in the same way that Nuix did, in the same way that Domino's Pizza did. And I think shareholders buying at $28.80 this morning are going to end up torching some dough.
I mean, we're not here to rip on one company, but I'm very much looking forward to going. I'm very much looking forward to going and having a burrito next week with you when I'm in Melbourne and we record, Luke, because it's going to be quite.
I'm not eating it good as anything Gomez after this goes up. They're going to start spitting in my burritos.
You're going to have a picture.
Yeah, they're going to put my picture up in all the shops. Look,
I think just one final point on that, just to round it off, is it's we might actually look at it at a certain price is the other thing. Like
correct.
Nuix fell loads and then doubled just recently. Pexa was another float that kind of was at the top of the market in 2020, 2021, whenever it was. Fell from $17 to
12.
What was it? 12, which is kind of where we bought shares in the last sort of 6 to 12 months. So look, we're not perma bears here, and we're not trying to hate on it. But
Benny and I are very much everything at a price. The question is what price?
Pexa's like another expansion story, but it makes like more sense, right?
Yeah,
I don't know.
Yeah, I don't know. It's one of these things where I think investors generalize as well. Like people look at the US and think, oh, this is a huge opportunity, and if they like the company, they'll just assume it's going to work. But yeah, PEX is one we've done a lot more work on in terms of the rollout story, and it gives us confidence. But anyway.
So we're going to talk about a smart beta ETF, and these things sound great in principle and in theory, and it's one of those ones that are good in theory and not so good in practice. So a smart beta ETF is simply this, is that rather than a fund manager doing fundamental bottom-up analysis of every stock and then creating a portfolio of the stocks with the highest return, kind of regardless of what sector they're in or what weighting they are in the index, a smart beta product uses some research database of all companies and an active manager type views on companies, but says instead of owning, let's say banks are 26% of the index, well, they will put 26% of the money in their preferred one or two banks. And then they'll look at utilities and they'll say, okay, our preferred utility stock is APA and the utilities are 4% of the index, so we're going to put 4% in APA. And so on a sectorial or industry type level, they are exactly the same as the index, but the underlying security selections are actually active stock picks. And because they're not really constructing the portfolio, and because they're just relying on an existing research database, normally a sell-side research company, the reality is there's not a lot of work goes into them, and they can sell them quite cheaply. And so the average sort of active beta, smart beta ETF available or fund available, they're sort of like 30 to 50 basis points versus an active manager in the same sort of category, probably more like 60 to 100 basis points as a general comment. So we did some work because Benny's going on and had a look at these products against active peers and even just a normal market cap weighted index. And, you know, they actually haven't been that good. Benny, do you want to maybe talk a bit about, you know, what we learnt and, you know, what your sort of takeaways are from it being a bit more of a traditional, shall we say, fund manager?
Yeah, I think, you know, as well, the return objective, it's not to try and shoot the lights out. It's just to try and be slightly better than the index. So when you look at some of these numbers that you crunched yesterday, Luke, on the FE Analytics, bit of a guru on the data there. So a couple of the names involved are Real Index. They do...
Good product. We use it.
Yeah. Macquarie has one, or it has a couple actually. CFS, Enhanced Index Balance. They're all kind of the same. Smart
JP Morgan have got one.
Yeah,
everyone's running them though. Like Vanguard have got them. iShares have got them. I think iShares are maybe just.
No, I think those ones, still those ETFs you're talking about, they're just geared. Like so the ones I'm talking about are generally called enhanced. So it'll say like you know, ASX 200 enhanced, or you know, index enhanced, or
I'm fairly sure. I'll have a look, but I'm fairly sure Vanguard and iShares both have partial active overlay, where, you know, it's based on
you can pay.
They'll enhance it, and their ETF is, you know, a Vanguard Australian 200 active, which is just a passive fund with a bit of in-house research overlaid on it.
Yeah, and I always sort of said this as a baseline. You know, is it easy to beat the index? Yeah, it is. All you do is you buy the index, and then with 10% of your money, or 1% of your money, or 0.1% of your money, just go and buy one extra share in one stock that you think can outperform over the next 24 months, and you'll beat the index. Or short the worst company in the ASX in the benchmark. You know, and so let's pretend that beating the index isn't that hard to do. The question is, you know, can you build a portfolio that can sustainably beat the index? And that's much harder to do. But I don't think that these smart beta products are trying to play on people's desire to create portfolios of the lowest fees rather than to create portfolios of the highest possible returns. And I think that's where this has all gone a bit skew-if.
And I might just highlight a couple of the numbers. I mean, I won't read out the names of the products maybe, but over 3 years per annum, we're looking at 8.7%, 6.5%, 5%, 5%. So when you compare that to the index, which has done 6.5%, it's kind of a spread around the index. So look, they're not necessarily guaranteed to, I mean, nothing's guaranteed, of course, but they're not, you know, on the whole outperforming the index. And just another one to throw in there, given it's right in our wheelhouse, the Seneca Australian Equity SMA, which it actually uses Real Index, I believe, Luke.
Yeah, it does.
Which is one of those smart beta.
At the moment,
it's a multi-manager product, free for clients, and it uses mainly active managers.
Including our Seneca Australian Shares SMA.
Yep, which for the record has outperformed all those products that I just read out.
Get the sales pitch in there, son. Go on.
You're one of those guys with the spinny sign at the front of the
That's us
at the moment.
That's us. I just stand on Flinders Lane with one of those spinny signs.
But, you know, I think it's just kind of highlights the point, active versus passive, that this is another category of passive that is not necessarily going to give you the best risk-adjusted returns depending on your circumstances. But
even our clients get our Seneca Australian Shares SMA that Ben's talking about. Like all our products free for our clients, and even if you're recommending that to one of your clients, they're only going to pay 45 basis points. Like I said, I think that Real Index product is 35 basis points. So you're not paying a lot extra on top of just a computer allocating, to sectors, a lot for our product anyway. And I mean, I know comparable products in our sector, our peer group, I think our peer group averages 80 basis points or 79 basis points or something like that. So, they are a little bit more expensive again, but for 45 bips, like as an external advisor, I personally think it's a pretty good deal. given, sure, we underperform like everybody else at different times, and we outperform sometimes. We've done a little bit better than the market, and hopefully we can continue to generate above index returns. But I just don't see the point in another enhanced product, and there's certainly these smart beta products aren't all equal. That was probably my point.
I mean, I know you said it's my favourite topic, these thematic ETFs, but
I'm only winding you up.
No, I know, but it is. It's my favourite topic because I see it as it's a little bit like half-assing something, right? Like if you're going to do one thing, just do that thing and do it well. If you're going to do index investing, then do that thing and do it well.
Correct.
Don't be like, but we can have a little bit of both and maybe that will turn out better. It's like, well, probably it won't because you're half-assing the active part of it, and active investing is hard and
you pay people to do it,
effort, and that's why it costs money. So, I'm a big believer in you should invest in what however you want to invest. And if you want to invest passively, then fantastic. If you want to invest actively, then fantastic. But I am conscious of the fact that so many of our clients, particularly our younger clients, who, come to us because they've seen an ad on Instagram or Facebook or TikTok or wherever about such and such as XYZ ETF. They don't understand what's going on in it. They don't understand what the fee is because it's inbuilt. They just think that they're paying brokerage for something that's free. And they don't recognize the fact that, what they're doing is halfway house.
They're managing their own portfolio. It's literally their own, it's active management. Picking a sector-based or thematic ETF or an active smart beta product, that's all active management. So if you don't believe that anyone out there can outperform the market, and you think that, even if they're out there, you don't think you can identify them. Well, by buying a sector-based ETF or by buying a smart beta product or by buying any of this stuff apart from a market cap weighted index ETF, you are doing exactly that. So it is, sort of logically inconsistent in my view, and I think in most sensible professionals' view as well. Benny, can you give us, maybe go through quickly, and I'm talking quickly, and when I mean quickly, I mean quickly. 3 stocks, run through them. What's good? What do people want to own? What's interesting for the watch list? And what's going to go up in the next 6 months? Out of the stocks, obviously that we own and buy, what do you think is red hot right now? People need to get their paws into, apart from the amazing products at Seneca Financial Solutions.
Apart from them, or even within them, let's talk.
Within them. Our favourites inside those, yes, correct.
Smalls, large, no preference.
Whatever you want, mate. Go. Do you think?
Okay, let's talk maybe smalls, and one we added recently.
Ooh.
And we haven't disclosed
haven't we?
Yet.
Exclusive for the Wealth
Sports Tech.
Exclusive for the Wealth and Toil podcast.
Exclusive for the Wealth and Toil podcast.
Exclusive to the Wealth and Toil podcast. Log into your CommSec accounts and plug it in.
Catapult, CAT, the code. Now, this is a business that probably some of the audience might be familiar with. They do kind of GPS tracking. And
they're the sports bras that all the footy
sports
players
bra,
wear.
correct.
Right?
The sports bras.
GPS
You often see them on the
sports
news. Yep. And
what news
they
are you
provide
watching
kind
when
of
people have got their sports bra on?
They provide player tracking data and analytics and software for professional sports teams to analyse their players and their performance. They're kind of well known in AFL and rugby and soccer. Some of the big leagues, pretty much, most of the
everyone. Yeah. I think they've got big market share, but it's like less than you would think. There's still a lot of sports teams that aren't using them. But there's no real other competitor. It's
like 20% of the sort of major sports.
I think 16. I think 16 is a number that's on the top of my head. It's in our notes, but it's as much as it seems quite low, they are actually the dominant sort of provider now.
Yeah, it's something like 20 countries, 40 leagues, sporting leagues, and 1,000 teams or something like that.
So Benny, what's our thesis here? Why do we buy it? Why do we buy it, and recently, and what do we expect to get out of it?
Yeah, it's been around for a few years and it's kind of been a bit of a mixed performance for shareholders. Why we're looking at it now is it's transitioned from upfront sales to a recurring subscription revenue model, and I've
This should be the Seneca tagline. Like it's getting out of control. Getting out of control.
Look, we've talked about one or two of them across the various channels. RPM Global is a good example of one software business that's done exactly that, and it's done well. And Catapult has kind of just done the same thing, and they just reported their result a couple of weeks ago, and it showed positive free cash flow.
The other tagline at Seneca, operating leverage.
And from here on out, the story is operating leverage. So, look, we think any incremental growth is going to be quite profitable. And where's the incremental growth going to come from? Well, I think that's pretty easy to see. Professional sports are, rising in popularity thanks to Netflix documentaries. Like they're in the F1 as well in terms of tracking as well. Netflix documentaries, sports betting, increased fan bases means more money that the teams have to invest in things like Catapult products. So, and women's sport is another one. Like that's
women's sport,
huge.
but even collegiate sport, high school sport, it's becoming much more serious. Like the seriousness of these sort of junior and sub sort of Premier League, sub, when I say Premier League, I'm not talking soccer specifically, but you know what I'm saying? Okay, NBA, and then it's, the G League, and then the college, and then the high school basketball. And I think the prevalence of the internet, the prevalence of sport permeating people from not just the TV networks, but other sources, I think is driving increased valuation for teams, which I think you can see across the sporting codes. And I think for Catapult, that's just going to be an increasing market opportunity. So underpenetrated, even though they are the dominant sort of, and they've got 16, 20% of the market. Increasing reliance on data in everything that we do, but sports specifically, and increasing number of teams that are financially viable to be able to use something like Catapult, and would use something like Catapult.
Do you know what it costs?
It depends on the players, the teams, what they do, what data they want. There's a range of different ways they can pay for it, but the point here is that we like it for those sort of market-based dynamics. It's B2B, not B2C. It's selling to make one sale and you sell to many. Especially if you do a league deal. The big one I think for them is the NFL. They were there. They're kind of not there now. I reckon they might come back. Who knows?
But that's because there's no point getting data on blokes sitting around on a bench for 40 minutes.
Come on, Dill. You're the
I'm
NFL.
A big NFL fan. So, but old mate, who comes on 6 times and kicks a ball in an entire game is not going to get a huge amount of benefit from wearing a Catapult vest.
But I want
to track his journey to and from the.
But as you know, it is big business, and big data is now the sporting industry. So look, that's our thesis for Cat. Code for that CAT. Benny, interest of time, you got one more. Make it a good one.
Hit it out of the park.
Why don't I just give a quick update on one we've spoken about before?
We got a new one? We don't have a new one, do we? We got a new one? We got a new one, but we can't talk about it yet.
There's a couple of new ones
another episode.
It can't. There's a couple of ones that we've got, but we can't talk about.
Fund investors will find out in the next couple of months, and non-paying clients will find out sometime after that, probably. So,
go give us an update.
You think, Luke?
No, give us an update. Go on. Do you think?
I was just going to give an update on GDC, which we spoke about last time when I was forced to choose one stock that I was most excited about by the podcast hosts. And they had a couple of updates recently, which I think is just worth touching on. One was of their 3 assets, they sold the second one, which was the edge data centers in Europe, at a large premium to book value, 40 or 50% premium. And
per share, what's that worth to investors?
Oh, well over $2. I think it was $2.
It was trading at $2 when we spoke about it.
It was trading at $2 when we spoke about it. And the other crown in the jewel is AirTrunk, which is the large hyperscale player. Think,
big
tech customers. Think
if Guzman and Gomez
AI.
if Goodisman and Gomez is on 30 times EV to EBITDA,
you'd have to think
Air Trunk's going to list on 300 times EV to EBITDA, right? Like but like if assuming Air Trunk does list on say 30 times, which I know Ben thinks that's a stretch, but I actually think that's totally fair and it will totally happen.
I actually don't think it's necessarily a stretch. 30 times. I think in my numbers I want to be a bit conservative, but they've had rumours that 4 bidding parties have come into the data room and submitted non-binding indicative offers. So it's good to get a bit of competitive tension to drive that.
So if it's 30 times, we've got $2 a share from ETIX. We've got the Perth data centre business they sold. Yep. That's another 50 cents, bit of cash. And then what is Air Trunk worth to them per share on top of that? Say $2.50 in intrinsic value currently.
Yep, $2.50. Say I think Air Trunk is worth at least $1, maybe between $1 and $1.50 per share. So I think we're looking at a share price of somewhere between maybe $3.50, $3.75, somewhere in that area.
Stock's trading at $3.23 at the moment. So yeah, we think that is a buy and still a bit of upside there, and yeah, worth paying attention to. Thank you, Benjamin. Good job as always. Dill, anything else you want to wrap up with today?
Mate, that was a pleasure. I feel enlightened.
As you should. You're lucky to be graced with our presence.
Yeah, absolutely. I'm going to go and buy every stock that we talked about because this is not financial advice. And I'll see you all in a couple of months when I'm rich. No,
that's it.
No, I'm good, Benny. Enjoy your holiday, mate. It's been all great having you on. Thank you for the first 6 months of this year, and I'm sure it'll be many more appearances.
Pleasure, gents. I'll think of some material when I'm overseas and come back refreshed and ready.
I'm sure you'll be looking at plenty of material overseas. Don't worry about that.
Yeah. All right. Next podcast, Ben's going to show us his European tan.
Yeah. All right. Well, look, Benny, appreciate your time as always. Get back to work, and Dill, have a great week, mate. I'll see you for a live recording next week in studio.
The dream.
We're going to do that over a beer, I think, which will be nice.
Nice.
So set your schedule for that. But guys, thanks very much.
Thank you. Have a great week.
See you, mate.